Hello students, welcome to another video of Upskilling Commerce. Today we will be discussing insurance. It is a basic saying that finance is the blood of business. Having adequate amount of finance helps businesses to cope up with their day-to-day activities as well as take long-term decisions which are very important for the survival and growth of any organization. But as we all know, uncertainty is a risk factor which cannot be eliminated or ignored. Unpredictable conditions can affect decision making, financial performance, and stability of the business. As uncertainty is not under control of human beings, we need such products or means that can provide us the required financial support on the occurrence of any uncertain event. One such financial product is insurance. Now let's see what is insurance. So insurance is a financial product designed to provide protection against potential financial losses due to unforeseen events. It operates through a contractual agreement between an individual or a business which is known as the policyholder and an insurance company which is known as the insurer. Now the next is functions of insurance. The first one is risk transfer. Risk transfer is a fundamental function of insurance where an individual or business shifts the financial burden of potential losses to an insurance company. In exchange for a premium, the insurer agrees to compensate the policyholder for specific losses outlined in the insurance contract. The second is financial protection. Financial protection is one of the primary functions of insurance, ensuring that individuals and businesses are safeguarded against unexpected financial losses. Insurance provides compensation for damages, liabilities, or income loss due to unforeseen events, reducing the financial burden on policyholders. Next is loss prevention. Insurers often provide resources and incentives for risk management, encouraging policyholders to adopt safety measures that can reduce the likelihood of claims. The fourth is economic stability. By providing financial support during times of loss, insurance helps maintain economic stability and consumer confidence, enabling businesses and individuals to recover. Next is facilitating credit. Insurance play a key role in facilitating credit by providing security to lenders and borrowers. Next is it reduces the financial risk associated with loans, making it easier for individuals and businesses to access credit. Now let's see some key components of insurance. The first one is policyholder. Policyholder is an individual or entity that purchases the insurance policy. This premium, the amount paid by the policyholder to the insurance company for coverage, it can be paid as a one-time payment or through regular installments. The next is coverage, the specific risks or losses that the insurance policy protects against is known as coverage. This can include health issues, property damage, liability, and more. Next one is claim, a request made by the policyholder to the insurance company for payment or reimbursement for covered losses. Next is underwriting, the process by which the insurance company assesses the risk associated with insuring the policyholder and determines the premium. Next is exclusions, specific situations or conditions that are not covered by the insurance policy. Now let's talk about different types of insurance. The first one is life insurance. It is a financial product designed to provide protection and financial security to beneficiaries upon the death of the insured individual. And the second one is general insurance. So it refers to a category of insurance that provides financial protections against various non-life assets and risks. Unlike life insurance, which focuses on providing coverage in the event of death, general insurance covers a wide range of situations including property damage, liability claims, and health-related expenses. Now let's have a look at different types of life insurance policies. The first one is whole life policy. As the name suggests, a whole life insurance plan offers financial security and insurance coverage for the rest of the life of the policyholder. It guarantees a death benefit to be paid to the nominees upon the policyholder's death, giving lifelong protection and a saving element. As long as premiums are paid, the policy won't lapse. If the policyholder does not pay their premium by the due date, the policy enters a grace period, which typically lasts for 30 days. During this time, coverage remains active and the policyholder can still make the payment without penalty. If the premium is not paid by the end of the grace period, the policy will lapse. This means that the insurance company is no longer obligated to provide coverage or pay out any death benefits. The next is term life policy. Term life policy is the simplest form of policy where premium is paid for a period of time and on the event of death during that time a cash benefit is paid to the family or anyone else you name as your beneficiary. When the term of your life insurance policy expires, so does your life insurance benefit. Many insurance companies offer term life insurance policies with minimum terms starting at 5 years and extending up to 40 years. 1 year term life insurance policy or yearly renewable term insurance policy is also available for shorter durations. Next one is a ULIP, which is also known as Unit Linked Insurance Plan. So, a ULIP is a hybrid insurance product that provides both life insurance protection and investment options. The premiums paid by the policyholder are split into two parts. One portion goes towards providing life cover, while the remaining amount is invested in various funds, such as equity, debt, or a mix of both based on the policyholder's risk appetite and financial goals. After a specified lock-in period, policyholders can make partial withdrawals from their investment fund to meet immediate financial needs such as education or medical expenses. Invested funds generate returns based on market performance. The net asset value of the funds fluctuates according to market conditions, impacting the overall value of the policyholder's investment. In case of the policyholder's demise during the policy term, beneficiaries receive either the sum assured or the fund value at that time, whichever is higher. This ensures that the family is financially protected while also benefiting from any investment growth. The next is money back policy. It is a unique type of life insurance that combines both insurance coverage and investment benefits. This policy is designed to provide regular payouts to the policyholder at specified intervals during the policy term, along with a death benefit in case of the policyholder's demise. The policyholder receives periodic payments known as survival benefits at regular intervals. That is, it can be after every 5 years. These payouts are a percentage of the total sum assured and provide financial liquidity during the policy term. In the event of the policyholder's death during the policy term, the nominee receives the full sum assured regardless of any survival benefits already paid. This ensures financial security for the insured's beneficiaries. If the policyholder survives the entire term, they receive the remaining sum assured at maturity along with any bonuses or additional benefits that may have accrued over time. Money back policies often include an investment element allowing for potential growth through bonuses declared by the insurance company based on its performance. Compared to traditional market investments, money back policies are considered low risk, providing guaranteed returns while also offering life coverage. Next is group policy. A group life insurance policy covers multiple individuals under one master contract, typically issued to an employer or organization. Each member of the group receives a certificate of coverage detailing their benefits. The amount of coverage is usually tied to factors such as the employee's salary or position within the organization. Employers can choose the coverage levels based on their policies. Some group life insurance policies offer portability, allowing employees to convert their group coverage into an individual policy if they leave the organization, although this may come at a higher premium. Group life insurance policies are typically renewed annually. Eligibility may depend on factors such as employment status and tenure with the organization. And the last one is pension plan. Pension plans combine life insurance protection with savings for retirement. In the event of the policyholder's death, the beneficiaries receive a death benefit, ensuring financial security for loved ones. During the accumulation phase, policyholders pay regular premiums or make lump sum contributions. These funds are invested to grow over time, creating a corpus for retirement. Upon reaching retirement age, typically around 60, policyholders can start receiving payouts from their accumulated funds. This can be structured as a lump sum or regular annuity payments. Contribution to pension plans may qualify for tax deductions under applicable laws, and the maturity benefits received are often tax exempt, providing additional financial advantages. Many pension plans allow policyholders to choose between different investment options, such as equity or debt funds, depending on their risk appetite and financial goals. Different types of general insurance, in which the first one is health insurance. It is a type of insurance that provides coverage for medical expenses incurred due to illness, injury, or other health related issues. It is designed to alleviate the financial burden associated with healthcare costs by covering a range of services, including hospitalization, surgeries, medications, and preventive healthcare. Health insurance aims to ensure that individuals have access to necessary healthcare services without incurring overwhelming out of pocket expenses. Some of the plans are Mediclaim, Family Floater Health Insurance, Senior Citizen Health Insurance, Critical Illness Health Insurance, Maternity Health Insurance, etc. The next is motor insurance. Motor insurance, also known as auto or vehicle insurance, is a type of general insurance that provides coverage for vehicles against various risks such as damage, theft, and third party liabilities. Motor insurance is compulsory in many countries, including India. According to the Motor Vehicles Act 1988, it is mandatory for all vehicles operating in public spaces to have at least a third party liability insurance cover. Next is travel insurance. Travel insurance is a vital consideration for anyone planning to travel, whether domestically or internationally. It provides financial protection against unexpected events that could disrupt your journey, such as medical emergencies, trip cancellations, lost luggage, and more. With increasing health risks and unpredictable global events, having travel insurance has become more crucial than ever. The next is home insurance. Home insurance, also known as homeowners insurance, is a type of property insurance designed to protect individuals from financial losses related to their homes and personal belongings. It encompasses coverage for both the physical structure of the home and the liability for injuries or damages that may occur on the property. Next is marine insurance. So, marine insurance is a specialized form of insurance that protects against the loss or damage of ships, cargo, and other maritime related liabilities. It plays a crucial role in the shipping and logistics industries, providing coverage for various risks associated with maritime transport. Key types of marine insurance are: first one is marine cargo insurance. So, this type of insurance covers goods being transported by sea. It protects against risks such as theft, damage, or loss during transit. The second one is hull insurance. It protects the physical structure of the vessel itself, including its machinery and equipment. This coverage is essential for ship owners to safeguard against damages from collisions, fire, etc. The third one is freight insurance. So it compensates for losses incurred by shipping companies if goods are damaged during transit, affecting their freight receivables. The fourth one is port risk insurance. This policy covers risks associated with vessels while they are docked at ports. It does not cover risks while the vessel is at sea. The fifth one is fleet policy. A fleet policy insures multiple vessels under a single contract, providing coverage for all ships owned by a company. The sixth is single vessel policy. So, this policy covers only one specific vessel, providing tailored coverage for that particular ship. The next is fire insurance. It is a crucial type of property insurance designed to protect individuals and businesses from financial losses caused by fire related incidents. This insurance covers damages to buildings, personal belongings, and other property due to fire, as well as certain related risks. Fire insurance typically covers damage caused by accidental fires, loss due to lightning strikes, explosions related to fire incidents, and damage from natural disasters like storms if they lead to fire outbreaks. Some other types of insurance. Keyman insurance. Keyman insurance, also known as key person insurance, is a specialized type of life insurance policy designed to protect a business from the financial repercussions that may arise from the death, disability, or critical illness of a key employee. This key individual typically possesses unique skills, knowledge, or experience that are vital to the success and continuity of the business. The primary goal of Keyman Insurance is to provide financial compensation to the business in the event of a loss of a key employee. This can help cover costs associated with recruiting and training a replacement, managing debts, and maintaining operational stability during a challenging period. Employee is both the proposer and the premium payer of the policy. The life insured is that of the key employee, and in case of their demise, the death benefit is paid to the employer. Typically, only pure term insurance plans can be purchased as keyman insurance. Next is cyber insurance. Cyber insurance, also known as cyber liability insurance, is a specialized insurance product designed to protect businesses from financial losses resulting from cyber attacks, data breaches, and other cyber incidents. As cyber threats continue to rise, this type of insurance has become increasingly important for organizations that rely on technology and store sensitive information. Cyber insurance helps businesses manage the financial impact of cyber incidents, which can include significant costs related to remediation, legal fees, and reputational damage. According to reports, the average cost of a data breach can exceed millions of dollars, making such coverage critical for risk management. Any business that stores sensitive customer information or relies on technology for operations can benefit from cyber insurance. This industries includes such as healthcare, finance, retail, and technology. The next is dental insurance. Dental insurance is a type of health insurance designed to cover expenses related to dental care. It can become increasingly popular as awareness of oral health and the costs associated with dental treatments grow. Here's an overview of dental insurance, its coverage, and its significance. Dental treatments can be expensive. Having insurance help mitigate these costs, making it easier for individuals to seek necessary care. Regular dental visits supported by insurance can lead to early detection of oral health issues, potentially preventing more serious health problems. The next is crop insurance. Crop insurance is a specialized form of insurance designed to protect agriculture producers, including farmers and ranchers, from financial losses due to various risks that can affect crop production. This insurance play a crucial role in stabilizing farmers' income and ensuring their financial security in the face of unpredictable agriculture challenges. Crop insurance aims to safeguard farmers against losses caused by natural disasters, adverse weather conditions, pests, diseases, and fluctuations in market prices. It helps mitigate the financial impact of events that are often beyond the control of farmers. Crop insurance typically covers losses from adverse weather conditions, damage from pests and diseases, income loss due to drastic price drops in agricultural commodities, specific events like fire or wildlife damage. Next is event insurance. Event insurance is a specialized type of insurance designed to protect individuals and organizations from financial losses associated with hosting events. This coverage can be crucial for mitigating risks related to unforeseen circumstances that may disrupt or negatively impact an event. Event insurance is essential for safeguarding investments in events such as weddings, corporate functions, concerts, and festivals. It helps ensure that organizers are financially protected against potential liabilities and losses that could arise unexpectedly. Individuals and organizations planning events ranging from private parties to large public gatherings should consider obtaining event insurance. This includes weddings, corporate seminars, community events, and more. Now let's discuss about leading insurance companies in India. The insurance sector in India consists of a total 57 insurance companies, out of which 24 companies are life insurance providers and the remaining 33 are non-life insurers, out of which there are 7 public sector companies. Some of the life insurance companies are HDFC Life Insurance Company, ICICI Prudential Life Insurance Company, Life Insurance Corporation, which is LIC of India. The next is Max Life Insurance Company, PNB MetLife India Insurance Company, SBI Life Insurance Company, and Tata AIA Life Insurance Company, and many more names. The next is non-life insurance companies. Some of them are Future General India Insurance Company, HDFC Ergo General Insurance Company, ICICI Lombard General Insurance Company, IFCO Tokyo General Insurance Company, Kotak Mahindra General Insurance Company, Liberty General Insurance Company, Magma HDI General Insurance Company, etc. Apart from all insurance companies, LIC is the only governmental life insurance company while the others are private. The next concept is third party insurance. Third party insurance is a type of insurance coverage that protects the policyholder from claims made by another party for damages or losses. It typically involves three parties. The first one is the insured individual or entity who is the policyholder. The second party is the insurance company which is providing the coverage, and the third party is the individual or entity making a claim against the insured for damages. Some key features of third party insurance are: the first is it generally covers bodily injury and property damage caused to the third party due to the policyholder's actions. The next is it does not cover the policyholder's own damages or injuries. Often required in auto insurance, liability insurance for businesses, and certain types of professional liability insurance. A common example of third party insurance is auto liability insurance. Let's see how it works. We just need to imagine a scenario. Imagine you are driving your car and accidentally collide with another vehicle, causing damage to that vehicle and injuries to the other driver. In this case, the first party will be you, the driver who is at fault. The second party will be your insurance company, and the third party will be the other driver and their vehicle. Now, what part is covered under the insurance policy? The first is bodily injury liability. This part of your policy would cover the medical expenses and lost wages of the other driver due to the injuries sustained in the accident. Property damage liability. This would cover the costs associated with repairing the other driver's vehicle. If the other driver files a claim against you, your third party liability insurance will handle the claim, paying for their damages up to the limits of your policy. This protects you from having to pay out of pocket for the costs associated with the accident. Here are a few examples of third party insurance beyond automobile liability. The first is professional liability insurance. A consultant provides advice to a client and the client suffers financial losses due to the consultant's negligence or error. This insurance protects the consultant against claims made by the client for damages resulting from professional mistakes or failures to perform services. Second is general liability insurance. A customer slips and falls in a retail store due to a wet floor and sustains injuries. In this case, the coverage will be general liability insurance covers the store owner against claims for bodily injury and property damage made by third parties. The third one is product liability insurance. A customer is injured after using a defective product manufactured by a company. So, product liability insurance protects the manufacturer against claims from consumers who are injured or suffers damages due to defects in their products. The fourth is directors and officers insurance. Shareholders sue the directors of a company for alleged mismanagement or breach of fiduciary duty. So, directors and officers insurance protects the personal assets of directors and officers in case they face claims related to their corporate decisions. The fifth one is workers' compensation insurance. An employee gets injured on the job and files a claim for their medical expenses and lost wages. While this primarily benefits the employee, it also protects the employer from lawsuits related to workplace injuries, making it a form of third party coverage in that context. These examples illustrate how third party insurance can apply across various fields and industries, providing essential protection against potential liabilities. The next is reinsurance. Reinsurance is a practice where an insurance company transfers a portion of its risks to another insurance company. This process helps the primary insurer manage its risk exposure and protect against large losses. A company may consider reinsurance under various circumstances, including the first is managing risk exposure. When an insurer has a large number of policies, especially in high risk areas, reinsurance helps spread the risk. Companies facing exposure to catastrophic events like earthquakes, floods may seek reinsurance to mitigate potential large losses. Second is stabilizing financial performance. If a company experiences fluctuations in claims and needs to stabilize its loss ratios, reinsurance can help smooth out financial results. Reinsurance can free up capital by reducing the reserves needed for potential claims, improving overall financial health. The third is entering new markets or products. Before launching new insurance products or entering new markets, insurers can use reinsurance to mitigate initial risks associated with unfamiliar territory. Insurers may seek reinsurance for specialized or unique policies that carry higher risks. Fourth is financial stability and solvency protection. When insurers anticipate potential large claims, reinsurance provides a safety net to protect against insolvency. Reinsurance can be a part of a long term strategy to manage accumulated risks and liabilities over time. The fifth one is cost management. By transferring some risk to reinsurers, primary insurers can offer more competitive pricing on their policies, attracting more customers. In summary, insurers may pursue reinsurance when they need to manage risk, stabilize finances, comply with regulations, expand capacity, or protect against significant claims. It serves as a crucial tool for maintaining the viability and competitiveness of insurance companies in the market. Let's see advantages in Indian insurance industry. The first is growth in the insurance sector. The insurance market in India is experiencing significant growth due to a combination of economic, demographic, regulatory, and technological factors. Let's discuss some reasons for this growth. The first is economic expansion. India's economy is projected to grow at an average annual rate of 6.4% between 2024 and 2028, which supports increased disposable income and consumer spending on insurance products. This economic growth creates a favorable environment for insurance uptake. The next is the expanding middle class in India is driving demand for various insurance products, particularly life and health insurance. As households become more affluent, they seek financial protection against unforeseen events. The COVID 19 pandemic heightened awareness about the importance of health and life insurance. Consumers are now more inclined to secure coverage to mitigate risks associated with health crisis and financial instability. And the Insurance Regulatory and Development Authority of India has implemented reforms aimed at simplifying customer experiences and promoting digital innovations. Initiatives like Insurance for All by 2047 aims to ensure comprehensive coverage for every citizen. The adoption of technology in the insurance sector has streamlined operations, enhanced customer engagement, and improved distribution channels. Innovations such as InsurTech, which terms that refers to the use of technology to improve the insurance industry are making it easier for consumers to access products and services. The next is attractive opportunities. As the industry expands, it generates numerous jobs across various functions, from sales and marketing to actuarial and data analysis roles. The expansion of the insurance sector is expected to contribute positively to the overall economy by generating employment opportunities. As new insurers enter the market and existing companies expand their operations, job creation across various roles from underwriting to claims processing will likely increase. The entry of foreign players is anticipated to introduce innovative insurance products tailored to meet the diverse needs of Indian consumers. This includes specialized offerings in areas such as agriculture, health, and cyber insurance, which are crucial for addressing emerging risks in a rapidly changing environment. The next is policy support. The Indian insurance sector offers several tax benefits aimed at encouraging individuals to invest in various insurance products. Here are the key tax benefits associated with insurance policies as of February 2025. The first is deductions under Section 80C. Life insurance premiums. Individuals can claim deductions for premiums paid on life insurance policies under Section 80C of the Income Tax Act 1961. The maximum deduction allowed is 1,50,000 per annum. This deduction applies to premiums paid for policies covering the taxpayer, their spouse, and dependent children. Next is about health insurance premiums. So, Section 80D, taxpayers can claim deductions for health insurance premiums under this section, but there are some limitations. Up to rupees 25,000 for premiums paid for self, spouse, and dependent children, and additional deduction of up to rupees 25,000 for premiums paid for parents if they are under 60 years. If parents are aged 60 or above, the additional deduction increases to rupees 50,000. Thus, the total possible deduction can reach rupees 1 lakh if both the taxpayer and their parents are over 60. Next is exemption under Section 10, subsection 10D. Any amount received under a life insurance policy is generally exempt from income tax under Section 10, subsection 10D, provided certain conditions are met. Specifically, if the premium does not exceed 10% of the sum assured for policies issued after April 1, 2012, or if the total premium does not exceed rupees 2,50,000 for ULIPs, then exemption is available. The next point is increasing investments. The Indian insurance sector is witnessing a significant increase in investment driven by several key reforms and market dynamics. Here are the primary factors contributing to its growth. The first is increase in foreign direct investments. The recent announcement in the Union Budget 2025 to 26 to raise the FDI limit in the insurance sector from 74% to 100% marks a transformative moment for the industry. This reform is expected to attract substantial international capital, facilitating deeper integration with global best practices and enhancing access to advanced technologies. The potential influx of foreign investment will enable insurers to innovate and expand their offerings, ultimately benefiting consumers through better products and services. The second is enhanced digital infrastructure. The government's emphasis on digital transformation is set to streamline operations within the insurance sector. Initiatives such as the revamped central KYC registry and enhanced broadband connectivity aim to improve customer onboarding processes and expand insurance penetration in rural areas. By leveraging digital public infrastructure, insurers can reduce costs and make insurance products more accessible to undeserved populations, thus broadening their customer base. The third is focus on rural market opportunities. With many initiatives targeting rural markets, including the transformation of India Post into an insurance distribution channel, there is a concerted effort to increase insurance penetration in these regions. The introduction of schemes like crop insurance is designed to provide affordable coverage addressing the needs of farmers and rural communities. This focus on rural markets presents a significant opportunity for insurers to tap into previously unexplored segments. And the fourth one is growth of gig economy insurance. Recognizing the importance of gig workers, the government is extending health insurance coverage under schemes like Pradhan Mantri Jan Arogya Yojana. This move not only addresses immediate healthcare needs but also opens new avenues for insurers to develop tailored products for this growing workforce segment. And the fifth point is regulatory support and simplification. So, the government's commitment to simplifying foreign investment conditions and reviewing existing regulations creates a more conducive environment for investment. This includes easing restrictions related to key management, appointments, and board composition, which can attract more foreign players into the market. The next is IRDAI, which is known as Insurance Regulatory and Development Authority of India. The Insurance Regulatory and Development Authority of India is the apex regulatory body overseeing the insurance sector in India. Established under the IRDA Act of 1999, its primary mission is to protect policyholders' interests while ensuring the orderly growth of the insurance industry. Here are the key functions of IRDAI. The first is regulation and licensing. So, registration of insurance companies. IRDAI grants, renews, modifies, suspends, or cancel registration certificates for insurance companies operating in India. Licensing intermediaries. It licenses and establishes norms for insurance intermediaries, ensuring they adhere to a specified code of conduct. The next is protection of policyholders' interests. Ensuring fair practices, the authority mandates that insurance companies adhere to high standards of service and transparency, particularly in claims settlement. The next is grievance redressal. So, IRDAI has established mechanisms for addressing complaints and grievances from policyholders, promoting effective dispute resolution. The third is financial oversight. It consists of monitoring solvency. It ensures that insurance companies maintain a solvency margin which is essential for meeting potential claims and maintaining financial stability. The next point is regulating premium rates. So, IRDAI regulates premium rates for various insurance products to prevent excessive pricing and ensure affordability for consumers. And the fourth is product approval. It consists of new product launches. Insurance providers must obtain approval from IRDAI before launching new insurance products, ensuring they meet regulatory standards and benefit policyholders. And the fifth one is surveyors and loss assessors. Insurance surveyors are professionals responsible for evaluating risks associated with insured assets. They conduct thorough inspections and assessments of properties, vehicles, or other subjects to determine their insurability and potential risks. Their evaluations help insurance companies establish appropriate coverage options and premiums for policyholders. Loss assessors represent the interests of policyholders during the claim settlement process. They assess the extent of losses incurred by the insured party and negotiate fair settlements with insurance companies. Now let's discuss some job opportunities related to sale of insurance products. The first one is insurance agent. Insurance agents play a crucial role in the insurance industry, serving as intermediaries between clients and insurance companies. Their primary responsibility encompasses a variety of tasks aimed at helping clients understand their insurance needs and securing appropriate coverage. Key responsibilities of an insurance agent are: first is client acquisition. Insurance agents identify and contact potential clients through various methods, including cold calling, networking, and referrals. Building a client base is essential for generating new business. Next is needs assessment. Agents analyze clients' risk exposure and financial situations to recommend suitable insurance policies. This involves understanding the specific needs of individuals or businesses. Third is policy recommendations. They provide detailed explanations of different insurance products, including terms, coverage limits, and exclusions. This helps clients make informed decisions about their insurance options. Next is policy issuance and renewals. Insurance agents assist clients in purchasing new policies and renewing existing ones. They ensure that clients are aware of upcoming renewals and any necessary adjustments based on changes in their circumstances. Next is claims assistance. When clients experience losses, agents guide them through the claims process, helping to ensure that all necessary documentation is submitted for a smooth settlement. Next is ongoing client relationship management. So, agents maintain relationships with clients by conducting periodic policy reviews and providing updates on policy performance. This ongoing communication is vital for client retention and satisfaction. What are the skills and qualifications that are required to become an insurance agent? So, to be effective, insurance agents typically require strong sales skills, excellent communication abilities, and a solid understanding of insurance principles. Many agents hold licenses specific to the types of insurance they sell. For example, life, property, casualty, etc., and may benefit from a background in marketing or business. In summary, the work of an insurance agent involves not only selling policies but also educating clients, assessing risks, facilitating claims, and managing long term client relationships. This multifaceted role is essential for helping individuals and businesses navigate the complexities of insurance coverage. Education and qualifications. So, high school diploma or equivalent, a bachelor's degree in finance, business, or a related field is often preferred. They must obtain a state license to sell insurance, which typically requires passing an exam. Additional certifications like Certified Insurance Counselor, Chartered Property Casualty Underwriter can also enhance credibility. The second one is a salaried employee. An employee of an insurance company working in sales commonly is referred to as insurance sales representative has a multifaceted role focused on selling insurance products and providing customer service. So here's an overview of their job responsibilities and skills. What are the key responsibilities? So the first is client acquisition. Actively seek out new clients through networking, cold calling, and referrals. Build and maintain relationships with potential and existing clients. Next is needs assessment. Assesses the insurance needs of clients by understanding their personal or business circumstances and providing tailored recommendations for insurance policies that best fit client requirements. Third is policy sales. Sell various types of insurance policies, including life, health, property, and casualty insurance. Explain the details of different policies, including coverage options, terms, and conditions. Next is customer education. Educate clients about the benefits and risks associated with different insurance products. Advise clients on how to minimize risks and make informed decisions regarding their coverage. Next is claims assistance. Assist clients in navigating the claims process when they experience losses. Ensure that claims are processed efficiently to maintain client trust. The next is record keeping. Maintain accurate records of client interactions, policy details, and transactions. Prepare reports on sales performance and client feedback for management. And the last is ongoing client management. So, regularly review existing policy with clients, especially after significant life events, for example, marriage, buying a home, etc. So, stay in touch with clients to discuss renewals or additional coverage needs. Skills required. The first is communication skills. So, strong verbal and written communication skills are essential for explaining complex insurance concepts to clients. A persuasive approach is necessary for effectively selling policies and closing deals. Building rapport with clients is crucial for long term relationships and repeat business. They must also have the ability to assess client needs and match them with appropriate insurance solutions. And managing multiple client accounts and maintaining detailed records require excellent organizational abilities. Now let's see some other job opportunities in the field of insurance. The first one is claim representative. A claim representative is a professional who works for insurance companies to manage and process insurance claims filed by policyholders. Their primary role is to ensure that claims are handled accurately and efficiently, serving as a liaison between the policyholder and the insurance company. Claims representative initiate, investigate, and process claims reported by customers. They ensure that all necessary documentation is gathered and reviewed. They interview claimants to collect relevant information and verify facts related to the claim. This may involve inspecting property damage or injuries. Representatives conduct thorough investigations to assess the validity of claims, which includes checking for potential fraud and contacting relevant third parties as needed. The next is insurance specialist. An insurance specialist is a professional who provides expert guidance and support to clients regarding their insurance needs. Their primary role involves analyzing clients' situations, recommending appropriate insurance products, and assisting with policy management and claims processes. Insurance specialists meet with clients to assess their insurance needs, evaluate risks, and recommend suitable insurance plans tailored to their specific circumstances and budgets. They assist clients in purchasing insurance policies, processing applications, conducting policy reviews, and managing renewals. This includes ensuring that clients understand the terms and coverage of their policies. These professionals stay informed about various insurance products, industry trends, and regulatory changes to provide accurate advice and recommendations to clients. The next is underwriter. An insurance underwriter is a professional responsible for evaluating insurance applications and determining the terms of coverage based on risk assessment. Their role is crucial in the insurance industry as they help balance the insurer's need to remain profitable while providing coverage to clients. Underwriters analyze the risks associated with insuring individuals or businesses by reviewing applications, financial information, and relevant background details. They decide whether to approve or decline insurance applications and establish the appropriate coverage limits and premium rates based on their risk evaluations. Underwriters work closely with other professionals such as actuaries, brokers, and claim managers to gather information and develop underwriting guidelines that align with company policies. Staying informed about market trends and changes in regulations is essential for making informed underwriting decisions. The next is actuary. An actuary is a highly trained professional who specializes in analyzing and managing financial risks using mathematical, statistical, and financial theories. Actuaries play a crucial role in the insurance industry by assessing risks associated with insurance policies and determining appropriate premiums to ensure the financial stability of insurance companies. Actuaries evaluate the likelihood of future events such as death, illness, or property loss and analyze how these risks affect insurance policies and financial products. They use complex mathematical models to calculate the premiums that policyholders should pay based on their risk profiles and the potential costs of claims. Actuaries provide expert advice to insurance companies on product design, pricing strategies, and risk management practices. To become an actuary, individuals typically need a bachelor's degree in mathematics, statistics, finance, or a related field. Additionally, they must pass a series of rigorous exams administered by professional actuarial organizations such as the Society of Actuaries or the Casualty Actuarial Society. The next is risk manager. A risk manager in an insurance company is a professional responsible for identifying, assessing, and mitigating risks that could impact the organization's financial stability and operational effectiveness. Their role is crucial in ensuring that the company remains compliant with regulations and is prepared for potential adverse events. Typically, a bachelor's degree in finance, business administration, risk management, or a related field is preferred. Many risk managers also pursue certifications in risk management or related areas to enhance their qualifications. And the last one is surveyor. An insurance surveyor is a professional who evaluates and assesses the risks associated with insuring properties or individuals. They play a crucial role in the insurance process by conducting surveys to determine the potential financial risks before an insurance policy is issued or when a claim is made. So that's all for insurance. Now we will meet up in the next lecture for discussion of further topics. Thank you.